Hi, I'm Jenny Brown. Welcome to MFB News. Thank you so much for joining us. I hope everybody's keeping really well. Things are okay with me. Hoping to exchange contracts on a house move, which we have been working on since July, no less. So hopefully we're going to exchange contracts today and then be moving next week. But it has been one of those purchases and sales, one of those experiences that I wouldn't choose to repeat anytime soon. So whether that will actually happen or not, I'm not entirely convinced, but fingers crossed for that. Now we've got some good stuff to cover off with you today. One of our key lenders has made some really good enhancements to their lending criteria, which I want to run with you. Another key lender has introduced some really nice cashback products, and there's been some other pricing movements with other lenders we're going to run through just briefly. Then I'm going to just share with you some statistics that have been released more recently with regards to mortgage interest rates, property prices, and also rental figures, which I think will kind of really set you up with the information that you need to make your investment decisions for the coming few months. Okay, so first of all, Capital Home Loans have kicked off 2022 by making some really good changes to their lending criteria, and I wanted to share these with you, partly because it's really wonderful that this is what they have done, but also actually some of the points that they have changed are quite interesting in terms of the broader market and how other lenders view these things. So first of all, what they're now agreeing to do is remortgage against market value and allow capital raising if you've owned a property for less than 6 months. So what this actually means is basically if you buy a property and want to refinance it within the first 6 months of ownership, there are lots of lenders who simply won't lend. There are some lenders who say, well, okay, we'll lend, but we'll only lend against what you have paid for the property, irrespective of the fact that it might have gone up in value. And there are other lenders who are willing to consider lending against market value. And this is kind of, the latter option is the one which most of our clients are really looking for, because they buy a property that's quite tired, they spend some money doing it up, they then want to refinance against the new market value, extract their capital and go again. So Capital Home Loans have moved into that market. They have now also reduced the minimum floor size for studio flats. They're now accepting properties which are 30 metres square or more. In terms of where that sits in the market, I think 30 to 35 square metres is where most lenders sit. We do occasionally get the odd client who comes to us with something which is around 25 to 28 square metres. We can find homes for these. It can be quite challenging, just because if you can imagine, these become quite tiny properties, and therefore from a resale demand it's going to be quite low, which is why lenders tend to steer away from them. But 30 metres square for Capital Home Loans is no problem. Now, another thing they've done is reduce the minimum valuation for multi-unit properties. So they've reduced this down to £150,000, which is really encouraging. They've also changed their rental calculation for individual borrowers. So they're now stressing at 140% coverage rather than previously 145% coverage. And this is for high rate taxpayers. So what this means in very short terms is that they will now lend more per pound of rent than they would do previously when borrowing in an individual name. They are also reconsidering the underwriting that they're doing on portfolios. So for those of you who are portfolio landlords, that's those of you with 4 or more mortgaged buy-to-let properties in the background, you will know from experience that when you apply for a mortgage, the lenders, under the guidance changes that came in a few years ago now, have to express more interest in your kind of background portfolio. So they're going to be looking at the overall gearing and rental yield that your portfolio has to make sure that everything is looking fairly solid. And so what Capital Home Loans are saying is that we're going to be kind of reducing the level of interest and underwriting that they're doing on the background portfolio, which is good. This really is just going to help speed things up, and also mean that the borrower has to provide less paperwork. Now, in addition to that, what they have kind of just refreshed our memories on, and there's a couple of USPs here that I think are quite unique as well, is that one of the things Capital Home Loans will do is lend on unlicensed HMOs on standard buy-to-let products rather than HMO products. So if you've got a property which is sort of a multi-let, but there's no licence required, then they're going to give you normal buy-to-let rates rather than HMO rates, which tend to be across the market a little bit more expensive. They do allow connections between freeholders and leaseholders. Not every single lender does. So if you can imagine, if you had a house, for example, that you split into 3 flats and you put long leases on each one, you sold one off but kept a couple, therefore you have control of the leaseholds and also the freehold. Capital Home Loans are a lender who can consider that arrangement. Again, not every lender will do. Another thing that they've mentioned, which I think is really worth sharing, is that they can lend on 100% of a block of 10 leasehold flats. So what most lenders will do is say, well, okay, if there's a block of flats, we're happy to lend on, you know, individual units, but we're going to cap our exposure within that development. And most lenders will say it's 2 units or 20% tends to be where the market sits. Whereas actually what Capital Home Loans are saying, that up to 10 will lend on all of them, which is really, really good. Now, in terms of Capital Home Loans, they are a specialist lender, so lending to individuals and limited companies. Layered companies are fine, no maximum number of properties in the background, and all that kind of stuff that we are very, very used to with those specialist lenders. And their pricing starts from a very, very good 2.69. So thank you, Capital Home Loans, for making these wonderful changes. Keystone have released some new rates which have some really, really healthy levels of cashback attached to them. So they have lots of different kind of product sets. They have a particular set of products which are available with the cashback. They also have kind of ones without cashback as well. Now the cashback products are the ones which really intrigue me because obviously I think everybody likes a bit of cashback, but also this can come incredibly handy if you have, or to help cover the cost of things like your solicitors, valuation fees and so on. So what they're saying is that there's different levels of cashback depending on the loan amount. So to be eligible for any cashback, the minimum loan requirement is £150,000 up to loans of £1 million. And the cashback range can go up to £3,000 here. Now, in terms of the pricing attached to their cashback range, the rates start from a very competitive 2.89%. And I say competitive because Keystone are a specialist lender who are lending on the more kind of unusual stuff. Just to give you a flavour of what that looks like. There are no maximum number of properties in the background, no minimum income requirement. They can lend to trading companies as well as SPVs, which is quite a unique point. You can be up to 80 at the point of application. They will do remortgages within the first 6 months of ownership. One of the things they do, which is quite unique in the specialist end of the market, is they do allow overpayments of up to 10% each year. Not every lender allows this, and some borrowers are quite keen to have that level of flexibility. They do allow you to let the property to companies and also DSS tenants and students as well. And you know what you'll clearly see here is they can lend to individuals and limited companies. With limited companies, they can take a view on things like layered companies. So I think it's fair to say that as well as having some absolutely cracking pricing, they are a lender who can kind of think slightly outside of the box in terms of what they will and won't do. Now, in addition to their kind of standard products range and also their cashback products, they also have an offering for expats. They have a green mortgage range as well. They're able to lend on HMOs and also multi-units. So a really, really healthy offering from Keystone this week. Some other quick changes on pricing for you in the last 7 days. So first of all, on our more kind of vanilla lenders, the Coventry have reduced their pricing. Their rates are now starting from 1.39%. They did have a slight pricing increase just before Christmas. I think they were getting a little bit busy, and so they kind of pushed their rates up to slow business down, so they brought them back down again. Coventry as a lender, I really, really like them. Now, they're very black and white in terms of what they will and won't do. Which actually can be a blessing because at least you know where you stand. I think there's a place in the market for those lenders. There's also a place in the market for the lenders who have slightly more greyness around their lending policy. But they're very, very quick to deal with. They're very, very easy to deal with. You can have up to 10 properties in the background with the Coventry. Now, one of the things that they have here, which is a rule which is quite interesting, which kind of sets them apart from lots of other kind of high street lenders, is that you can have 10 buy-to-let properties in your own name, but unlimited in limited companies. They don't consider those as being in your ownership, whereas other lenders would include limited company-owned properties within their allowance of 10 properties in the background. So that's really nice. No minimum income requirement. They're very generous on ages, and their rates are very, very good. Pricing now starting from 1.39%. They always have free valuations, be it purchase or remortgage. And also on remortgages, you will get free legal work as well, so very competitive. We've also seen Accord Mortgages reprice. Their rates have now increased, albeit slightly. So their pricing now starts from a very good 1.3%. Now, Accord are quite similar to Coventry, I think, in terms of their lending policy. So 10 properties in the background, they do count those in limited companies, I'd hasten to add. No minimum income requirement, individual names only, that kind of stuff. But look, the pricing, despite having gone up, is still very, very good. Now in the more specialist end of the market, we have seen Fleet reduce their rates. Their pricing now starts from 2.59%. As a specialist lender, Fleet can lend to limited companies and individuals. They do have a product set for HMOs and multi-units where the pricing starts from a higher base level. And again, lots of good criteria that you would expect from specialist lenders. Likewise, Vida are an interesting one. They've done a reprice and they've kind of rebranded, and they've brought out a new logo, and they've done loads of exciting, jazzy stuff for the start of the year. Their repricing, it's really hard to kind of determine actually whether rates have gone up or down. They've kind of just rejigged things slightly. I would say that despite bringing out a bunch of new products, the kind of change would sit in a neutral territory. So there you go, some quick updates in terms of other pricing from the market this week. Halifax have published their most recent house price index, and as always it makes interesting reading. So some key data for you. So in 2021, average house prices grew by 9.8%. The strongest region was Wales, reporting growth of 14.5%, followed by Northern Ireland at 10.6% and Scotland at 9.7%. Unfortunately, London saw the slowest level of growth, albeit it was growth at 2.1%. So all these things kind of combined, the average house price now sits at £276,091. Now, Russell Galley, who is the managing director of the Halifax, and therefore someone that I feel probably knows a thing or two about the housing market, has made some comments with regards to where we are now and what he expects to see in the coming few months. So first of all, he has commented that more people currently have savings behind them owing to a lack of spending opportunities in 2021. This, combined with the lack of housing stock on the market and low mortgage rates, is really going to kind of keep the market stimulated in the early part of 2022. However, he continues to warn inflation, mortgage rate increases and increased pressure on household budgets will mean that the market starts to really slow in 2022. And he's not expected to see anything like the level of house price growth that we witnessed in 2021. But he is still expecting growth nonetheless, with a cautious kind of remark at the end, saying that actually there are some variables that could maybe impact house prices to a negative, and it's really going to depend on how the pandemic continues to impact the economic environment. But look, in the round, I think what he's saying is the expectation is that house prices will continue to rise, and this has been reflected in the commentary we're seeing from other kind of experts across the board. Now, I stumbled across some data in the week that I wanted to share with you, which is really relating to what's going on with the private rental sector and rental yields themselves. So HomeTrack have produced their Q3 rental market report for 2021. Now, first of all of us are going to go, crikey, that's really out of date. But actually, if you think about it, by the time the data for these reports are finished and then collated and then analysed and then pushed back out to the public, these really are kind of as recent as you're going to get for a lot of them, I'm afraid. But look, it's really, really interesting reading. So what they're saying is the availability of properties to let is 43% below the 5-year average, while tenant demand is 55% above the average, which is contributing to a 13-year high in rental inflation. Now, really what they've said in their article, reading through the kind of background information on this, is that there's lots of reasons as to why, but the rental yields are going up. But one of the key things is that there are not a sufficient number of new properties coming to the market to rent, partly owing to the fact that some investors have pulled out of being landlords, and also the number of new investors coming to the market has really slowed down. And the report really apportioned this to the kind of various changes that have been implemented over the last few years with regards to tax and licensing and regulation and all the kind of stuff that comes with being a landlord. So not enough properties are coming to the market. Likewise, in the last 12 months, we have seen a real swathe of people who've been looking to kind of readjust their living arrangements, so where they're living, looking for bigger properties with an extra bedroom because they need a home office and all these kinds of things. There's been lots of movement of tenants as well, and really what that has done as a kind of snowball effect has really driven up the rental yields to the point where they're now at a 13-year high in inflation. There's no expectation for this to kind of go the other way. Again, things will probably start to slow down over the coming 12 months, but actually when you read the various reports about predictions for rental yields over the next 12 months and even beyond that, the expectation is still very much that rent is on the increase. And lastly for this week, interest rates. So MoneyFacts have released some data which is reporting on what is going on with mortgage rates across the market. So for those of us who will recall that in December we saw an increase in base rate of 0.15%. Beyond that in the market, the average 2-year tracker rate has now increased by 0.17% to 1.75. 2-year fixed rates on average have increased by 0.4% to 2.38, and 5-year fixed rates have increased by 0.02% to 2.66%. And these increases this is the third consecutive month that we've seen these patterns essentially. And all of this is really linked to the cost of funds on the money market and also the expectation about what base rate is going to do. Now, when we're looking forward, everybody who knows about interest rates and can kind of talk about what's going to be happening with them are predicting further base rate increases over the coming 12 months. Some people are actually expecting one in February. Whether that will happen or not, who knows, but you know, things are kind of moving on apace. And so what's happening is the cost of funds on the money markets are going up around nervousness over this, and therefore the lenders' pricing is driving up as well, and that's really reflected in these figures here. Now, this data is tracking interest rates across all of the markets, so homeowner, buy-to-let and so on. And this is really showing you the average of that. So I think it's always really confusing in terms of the messaging we're giving to you, because on one hand I'm saying, oh, the Coventry have reduced their rates and, you know, Vida Home Loans and all the rest of it. And on the other hand, I'm saying the average interest rates have actually gone up. So just keep in mind this data is reflecting the whole of the mortgage market. But I think you get the gist in terms of what's going on with interest rates, where the thoughts are in terms of where things are going to go. Interestingly, I was reading a report on remortgaging, and remortgage business at the moment for lenders is really spiking, as lots of borrowers are really kind of realising that there's a golden moment in time here to kind of nick in, grab a great rate. And if you are one of those people, please do give us a call. We'd love to have a chat with you around your mortgages and how we can help you secure one of the very, very good rates that are still on offer while they're still there. Is it for me this week. Thank you as always for joining us. I hope you found that helpful. Hopefully next week I'm going to be sharing with you that I have exchanged contracts, and I'll be surrounded by moving boxes because I'll be moving 2 days later. We're waiting to see on that. As always, if you have any questions, we'd love to hear from you. 0345 345 6788, or there is a plethora of information available on our website as well, mortgagesforbusiness.co.uk. Please do look after yourselves, and I will catch you again next week.